Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is our good friend Peter Boockvar. He is the Chief Investment Officer with Bleakley Financial Group. Welcome back, Peter.
Thanks, Ivan, for having me.
Yeah, it's an absolute pleasure having you back on. Peter, there's been some crazy news this past week about Silicon Valley Bank being shut down by regulators. How serious is this situation, and will it be more widespread to other banks and markets? What's your opinion?
Well, we know that it's serious, of course, because it was bailed out and the size of the bank was obviously substantial. So really the question is what does this mean for the rest of the banking system? And well, it's the reason why Silicon Valley went under, and that's because of the huge mismatch between their assets and liabilities and the huge amount of duration that they took in their hold to maturity book. So there are other banks that have done the same, sort of forced upon by the Fed when they had very low rates in 2000, 2001.
Hmm.
So the question now also is, well, we've guaranteed the depositors all their money back in Signature Bank and SVB. And is that an explicit guarantee of all depositors above the $250,000 US limit or 500 per joint account, or not? And
Hmm.
because there is a gray area, I still think you're going to have people that take money out from small and medium sized banks until they know whether they are protected or not. So there's still going to be, I think, disruptions. Uh, when you have a vertical rise in interest rates in 1 year, you're going to have accidents
Hmm.
galore. And the first one, the first accident from easy money was inflation, and now it's accidents in the banking system. So, but even if we don't have any more sort of closures or failures, you're going to have banks that are going to be forced to raise the interest rates they pay on savings and checking accounts, which means
Right.
that their loan spreads are going to get squeezed, and likely in response, they're going to limit lending, and the economic impact from all this is next to come.
And we've seen just on the news of Silicon Valley Bank, and now you brought up Signature Bank has also been halted by regulators. We've seen gold and silver prices shoot up a bit. What will these banking failures cause precious metals to go to new strengths? What do you think?
Well, the precious metal rally was an immediate response to the very sharp drop in interest rates, the possibility that at most the Fed has one 25 basis point rate hike left,
Right.
and the sharp weakness in the dollar in response to that. So to me, the bear case for gold and silver was really, okay, strong dollar, aggressive Fed. Well, now we have no longer an aggressive Fed in terms of continuing to raise rates, and the dollar really beginning in November rolled over. So to me, it's sort of a green light for gold and silver. And I think, I hope, I've said it before, that maybe this is the beginning of something more than just 1 or 2 day snapback rally.
Well said. How trapped is Powell in your opinion, Peter?
Extraordinarily trapped, and more so because of still elevated and likely persistent inflation. So let's just say we have continued stress in the banking system, we have an economic recession, and so on.
Hmm.
His hands are going to be somewhat limited to aggressively responding to that because of high inflation. That if he starts to cut interest rates notably, if he stops QT, then you can see a reversal higher in inflation trends. So out of if there's one thing to trap a central banker the most, it's having to deal with external problems at the same time inflation is high, and that's the exact scenario that not just Powell has, but all central bankers have.
Right, because with everything happening with Signature Bank and Silicon Valley Bank, people are saying inflation is gonna be here to stay because everyone basically getting bailed out. What's your thoughts there? Can we see inflation go out of control now that all these banks are going to start getting bailed out?
Well, I don't want to say out of control. We'll have to see. Right now, inflation is still on the downtrend. There still is disinflation that will continue to occur
Right.
as the year progresses. The question is where does inflation settle out at? And if the U.S. government would continue to throw money at each of these problems, then yes, that potentially could at least put a floor underneath inflation. But I certainly don't want to use the term out of control for where potentially inflation could go, um, further down the line.
Hmm. Peter, there's also news of Credit Suisse. Their default swaps have hit basically all new all-time highs, and insurance to protect against these default on their bonds is skyrocketing. What is that telling you?
Well, that's been a troubled bank for the past year, of course. And I think that people are just sort of gaming out is at what point does the Swiss government step in to stem a lot of what's going on there? So I would assume that they do at some point.
Hmm.
But yeah, it's another reflection of stress. But Credit Suisse's stress didn't just all of a sudden start. It's been going on for the past couple of years.
Hmm. And the Fed watch tool now is pricing in a Fed pause after the 25 basis point raise next meeting. Then they're pricing in no change in May. And so, your opinion, do you believe we have reached the limit of interest rate hikes?
I think that is very clear. If there was two things that was going to stop the Fed from hiking, well, I should say three. One was inflation falling notably.
Hmm.
That hasn't happened yet. It would be the unemployment rate going to 4.5 to 5. That hasn't happened yet. And it would be major dislocations in the markets and with the financial system, and that clearly has occurred. So we've checked now one of those three boxes, which is enough to get the Fed to stop, at least pause, see what the ripple effects are and how this settles out, and then can make decisions thereafter.
Hmm. And I was taking a look at some research online, and basically the Fed is sitting on unrealized losses of about 1.2 trillion on their 8.3 trillion bond portfolio. Is that even worse than the situation with the Silicon Valley Bank?
Well, if you look at, according to the FDIC, as of December 31st, the entire U.S. banking system had mark-to-market losses in hold to maturity sides of the portfolio of about 600 billion. But we know the Fed classifies their losses as a deferred asset, and it's not necessarily going to affect what they do. So it definitely garners headlines, but I don't think it's necessarily going to matter for how they implement policy.
Hmm. Right now, with all the chaos happening, where would you put your money, Peter, personally?
Well, we invest for clients,
Right.
so we still like at least in the energy sector, in the commodity space, uranium, precious metals, still tilting towards international markets relative to the U.S., particularly in Asia, and still finding some cheap value stocks in the U.S. Wanting to avoid still growthy tech, even though they've re-rated. I still think that there's further re-rating to go.
Hmm.
I think with one of the consequences of the negative potential impact on VC funded companies, unfortunately, because you have to feel bad for them for the sins of the banks that they put their trust in. If there's less VC funded companies, there's less demand for other tech products that are sold to those. So I'm still more leery of tech and
Hmm.
expensive parts of the market because overall, the big cap techs are still expensive relative to other parts of the market.
Yeah, well said. And Peter, in 2023, the Fed will post its first annual operating loss of 80 billion, basically since 1915, and it will have a negative capital of about 38 billion. In your opinion, what's your outlook for the US dollar within the next 3 to 5 years with all the losses with the Fed and all the negative capital that they're seeing? What's the view for the US dollar in the next three to 5 years?
I think more influential to the direction of the dollar is going to potentially be more so on the fiscal side and
Mm.
the debts and deficits of the U.S. government. And I think that is what can be more of a dangerous mix for the dollar. We're about to, we're in recession. We're about to enter one with debt to GDP ratio, or I should say, the budget deficit as a percentage of GDP ratio already at 5%, and that is before really a notable decline in the economy. So that has the potential of really going much higher. At the same time, we're obviously $31 trillion of debt. To me, that's the real headwind for the U.S. dollar, more so than the Fed's balance sheet.
And Peter, what's your outlook and your views for China reemerging into the economy? How will that have effect on inflation and the market as a whole?
Well, putting aside the geopolitical friction, having the Chinese economy reopen is certainly a good thing for global economic activity. When you're talking about 17% of the world's population that has been locked up for 3 years. So I think the reopening is certainly a positive, but will be more so for the Asian region, will be more so for Europe and European companies that do business with China. Less so for the U.S., since we really buy more stuff from them than they sell more stuff to us than we sell to them. So I think it's definitely be a positive, and I think as the year progresses and it fully opens up, and hopefully people, you can have younger people that are going to feel liberated, and maybe some older people that still have PTSD from all the lockdowns. But I think as the quarters progress, you'll see greater demand for energy, greater demand for other commodities, and also could be one of the factors that keep a floor under inflation.
Well, Peter, we want to thank you so much for coming down to Wall Street Silver, and hopefully as the market develops, we can have you back in the next 2-3 months.
Yeah, for sure. Thanks for having me.
Awesome. Talk to you soon.